For those of you that have been living under a rock, we did have the RBA announcement yesterday, the first meeting that was held by the RBA for 2024. They are revising things slightly, and I guess there has been a little bit of a shake-up in their policy and how they are presenting themselves from potentially even a PR perspective. We all love Michelle. Michelle Bullock is the new RBA governor, and she really is taking a very, fresh and new approach with how she is operating and how she is approaching things. And that's probably what we'd like to unpack today. We do have some questions that have been submitted already by you, our property investment audience from the Facebook group, High Performance Property Investment, but then also in our private at Ripehouse Advisory Mastermind group. So we will be working through those questions today and contributing where we see fit. So let's just jump right in. We all love Michelle. We are referring to a few articles and comments that have been out in the media in the last 24 hours, particularly on the Financial Review, but then also going back in the last week or two around tax revisions or policy revisions, and then also interest rates which have already been cut by by a bank in Australia. So we will be unpacking these concepts. Once again, if you do have any questions, please put your hand up and reach out, and we will try and get to those if they are relevant. And this is going to be our format going forward. We are going to be really trying to contain individual topics in our masterminds and then really unpacking those at a deeper level as a group. So let's jump right in, guys. Probably the first question I think we might cover off, if that's okay, is a question from Ryan. And that's from our Facebook group, so definitely jump over there. The question is, what's the truth behind the mortgage cliff rumours that have been floating around since rates began increasing? And, is this a flag post for them to be moving again and again? So this mortgage cliff, just before we jump in, for those that don't know, we have a very low fixed rate interest rate going into COVID, and throughout the COVID period, a lot of people move their variable rate over to fixed rate, and those are now coming off the minimum required fixed rate period, and causing potentially a mortgage cliff. So all of these people now with very low interest rates moving over to a higher interest rate all at once and causing dramatic mortgage stress across the community. So that's the mortgage cliff, and that's the concept. I might throw to you, Damian, in the first instance, if that's okay, just to answer, is this a thing? Are you seeing it on the ground as a very large mortgage broking business in Australia? And what potentially can we do to minimise the effects on us?
Yeah, thank you. Really good question, and a very important one. There definitely were a lot of customers who took advantage of very low fixed rates.
Yes.
Rates as low as 1.99% for 3 years during the COVID period, and that was extremely attractive. And a lot of people did take it up. For the first time in Australian history, we had a lot more mortgages that were fixed than variable. Traditionally, Australia has a variable rate market home loan industry. And so, there were a lot of loans, probably close to 70% of all lending went into fixed rates during those 6 month time. Now, to give you an idea what's still coming off, because we've weathered a lot of the storm, there is probably, I think from RBA estimations, about another 400,000 mortgages coming off fixed rate between now and the end of June. Now, what does that mean? So if you look back, a lot of people actually were taking a rate. So to give you an example, March 2022, just before the rate period really started to accelerate fixed rates,
yes,
you were just getting the hangover from the first increases to fixed rates. You were going to get something around about 2.49 originally, and then very quickly it turned to around about 3.19 for a 2-year fixed rate mortgage. So March 2022, 2.49 was originally advertised around about January or Feb. Rate increases quickly changed the market. You then ended up getting a 2-year fixed rate for 3.14. Still very attractive, and a lot of people took that up just to try and get ahead of the curve. So they're coming out at the moment. They're getting into an environment probably in the low or mid sixes. So you're talking quite a bit more than what they're actually on, 3%. So that's going to have an impact. But I think one of the reasons we probably haven't experienced a lot of carnage per se, which was maybe talked about from a mortgage cliff and a subprime market almost occurring, was that Australians had saved a lot in their offset accounts or just general saving balances. I think RBA estimates during sort of the back end of COVID, as they were starting to lift the interest rates,
Yes.
they had a comfort that they could do that because there was about $200 billion of offsetted savings
Wow.
against that people had the ability to draw on to sort of minimise the rising cost of interest rates. So, will it be detrimental? I don't think so, but it is actually something that's very active in our sort of marketplace, in our business. We are very acutely aware of our clients that are coming off their fixed rates, and we preemptively contact them to understand what sort of rate options we can get them into as they're rolling from a very low rate into, something as much as 3% higher.
So, Damian, when you say 400,000 coming off or coming into a mortgage cliff, I guess, before middle of this year, can you paint some colour around that? So you mentioned 70% had moved to a fixed rate through COVID. That seems very high to me. What would be the traditional fixed to variable percentage?
Generally the other way around, about
Yes.
70% variable. So about 30% fixed is traditionally, unlike a lot of other countries around the Western world, America, the UK, predominantly a fixed rate market. So when you see the Fed Reserve, Jerome Powell lifting interest rates so aggressively, it's because there's a very little effect to most mortgage holders.
Yes.
Most mortgage holders are getting 30-year fixed loan terms, and they're not impacted by the interest rate cycles. I found an interest rate that I like, I can afford that. I've now locked in my mortgage lifespan for that rate. UK is very similar, so 10-year mortgages are very much common over there.
Wow.
And so, in Australia, we've been typically a lot more affected by variable rates. There's a lot less competition in the Australian mortgage market. And so, fixed rates tend to be quite high comparatively to what you can discount on a variable rate mortgage. And hence we see traditionally a lot more people in variable trying to, get the best discount.
So I'm just trying to do some mental maths here. So 400,000 coming off the mortgage cliff. How does that compare to the total number of mortgages? Are we talking, 1 in 10 or 1 in 100, or, is this going to be?
Well, that's an estimate. There could be more, but that's just what's rolling off. If we go back to 2022, you could get a 3-year fixed rate mortgage for under 4%. So people were still opting for, I want that stability. I'll go for a, let's say, 3.99% 3-year fixed rate as opposed to the 3.14%.
Yes.
And depending on what lender options were there, a lot of people were quickly getting into what was, probably the last of the low fixed rates. And it was rapidly changing. Every couple of days was a new increase announced by lenders on their fixed rate pricing, because that's not really associated with reserve cash rate movements. That's banks can make an amendment to their fixed rates at any time. Recently, we've just seen some banks like Macquarie drop their fixed rates. So it's totally out of cycle what we see traditionally with the variable rate market.
Interesting. Did you have a comment there, Mike?
Yeah, look, some really impressive insights there from Damian. For me, it's simple. It was a beat up. The mortgage cliff. I mean, if you think about a cliff, right? It's a perilous thing where you can fall off and at the end you die. I think that was kind of the media beat up, is that we had all these borrowers on these fixed rate mortgages and they would fall off the cliff and the property market would explode and people would be selling at a loss. And I think it's not unusual of the media, of course, to paint a dire situation, but as Damian says, we've already gone through the majority of this. We've had this in the past, in or just before APRA, we had the fixed mortgages that were, the APRA intervention, and this is a similar story. It was a bit of a beat up then; it's a beat up now. I think the big difference is that we have huge savings ratio that was really kind of helped by COVID, right? Because not only did we have uncertainty, and there was a very short window of time where we were all kind of a little bit terrified. People were talking about 30% unemployment. People were talking about, do I buy canned vegetables or a shotgun? Like what is the world going to look like, right? So what happened is that people built a war chest, which is sensible, right? But then, of course, they realised that the sky isn't falling, and then they've got this money, and we saw an uptick in things like renovation and household expenditure. But, you couldn't go overseas, you couldn't go out to dinner, so people kind of sat on this cash. And I think the other thing in concert with that is that I think everyone knew in their heart of hearts, if they're fixing at 1.99%, that's not going to be forever, right? So a lot of people were paying more than the minimum. They were ahead, or at least their mindset was ahead of it for me.
So that's what you've seen as well, Damian. You know, people have sat on that war chest, and we've got $200 billion sitting in offsets. So people haven't been paying the minimum fixed rate amount. They've really been trying to get ahead of the curve. And that's not everyone, obviously. There's going to be people that really are struggling to meet those minimum repayments on fixed. But you're saying, let's get ahead of this. Let's not make this a cliff. If there is any possibility of it being a cliff, let's minimise those impacts. And that's coming down to, you know, a case-by-case basis. So each person's solution to minimising the impacts of fixed going to variable will be different. And your options potentially will be different as well. So there are some things that we can do, I think, is the takeaway. So we can agree, probably not likely for a mortgage cliff to be coming anytime soon, guys.
No, not in the sense of a catastrophe, that's for sure.
It's a mortgage hill, a mortgage grassy knoll.
And, you know, this is on the back as well. I think the commentary in the last sort of just before this session, guys, was around, look, we've got a Labor government who are looking at tax cuts, third stage tax cuts. So there's going to be more money floating around for the average mum and dad. We have an RBA who have chosen, which is the topic of the conversation today, in their February meeting to hold interest rates where they are. And the sentiment, as evidenced by Macquarie Bank, who have already reduced their fixed rates. So they are making a bet, and they've made the call that they feel fixed rates are going, or interest rates are going to be coming down, guys. So the sentiment and the feeling coming from the RBA is interest rate decreases in 2024. So these are all factors that are working for us as property investors, and, you know, giving us a little bit of confidence that not just this not going to be a mortgage cliff, but, you know, our own portfolios, our own wealth generation is potentially going to be, you know, we've got some factors working in our favour this year. So I love your work there, guys. Another question here. It's probably more relevant to you, Julian, from a strategy perspective. I know you work with many property investors on a daily basis, and, you know, moving those chess pieces around to you know, what is the next acquisition for these investors. So this is a question from James. James is a long-time friend of Ripehouse Advisory, and we've been very proud to work alongside you in acquisitions in the past. James, over on the Facebook group, who's made this comment. No surprise, really, with the RBA leaving rates as they are now. We didn't get the interest rate drop yet. I doubt we will get any rate rises from here on in, so that's James's opinion, especially if inflation rate stays the same or lower. Borrowing is difficult with lender requirements at present calculating at about 9% service rate, which is something that you touched on in our previously, Damian, in our conversations together. Just so you know there, with what James's comment is, even if you go to the bank and they're offering you an interest rate starting with a 6, they're assessing, can you afford that interest, can you afford that loan based on an assessment rate of 9%. Okay, so the banks have been very conservative as it is. He's just asking, is that correct? And it is, James, just confirming. So this is the question. How will investment house prices be impacted or affected if we receive no interest rate drops until November or December this year? Confidence may grow with lower inflation and shortages of houses. You know, supply and demand is very tight. Is it possible we will see house prices rise along with rental returns this year? So I might throw that over to you in the first instance there, Julian, to answer that question for James.
Yep. Thanks, Jacob. Yeah, I think it's a good question by James. Really, with house prices, just like just about anything, you've kind of got three factors to consider. You've got supply, you've got demand, but then you've also got confidence. So kind of like Mike mentioned before, when COVID just kicked off, confidence was at low. It's just get your shotguns, lock up the house, don't do anything, save your money. Same thing happens when you're clicking on news.com every day and you're seeing interest rate hike, mortgage cliff. If you're a first home buyer or thinking about going to investing, if you've got that news being thrown at you, or you've got people in the water cooler saying, oh, you don't want to buy a property now, it's going to crash by 30%, that leads to really just dropping in that confidence. Even with the rates being on hold, and I guess from an advisory level and an inquiry level, it has significantly increased since around about late August, September last year. There has been a significant increase of people inquiring about getting back into the property market, whether it be first-time investors or people coming back from previous years again. So, it's no secret we're at an extreme supply shortage, and that's kind of piggybacked off the back of population, immigration growth coming through, and also people are kind of forgetting the building industry's basically on its knees. You have 4 years of interrupted construction, house construction coming through. No new stock means there's no old stock to be pushed out. So people are still kind of fighting tooth and nail to even get whatever listings are available. And that is still going to continue to drive up the prices. Now, that won't happen in all markets like we're seeing here in Melbourne. And it's kind of the back off some policy changes, and me and Damian probably won't get too much into that. Otherwise, we'll take up the whole podcast here. But, we're going to see markets within markets, and just as a whole, you will still see the property prices push through as long as that narrative continues to, even if it's a neutral level. But we're already seeing, I think I saw the very first article just the other week on news.com where it's saying property prices set to soar in 2024. That's what you get. You always get these extremes where it's either mortgage cliff or property price is going to be so unaffordable you won't be able to buy a house. So I think it's probably going to be more the latter than the first.
Well, I think you're right, Julian. And if you look at history, you can throw everything but the kitchen, and the kitchen sink at the Australian property market, and you're not going to dent it. Throw a GFC, not denting it. Throw in a global pandemic, everyone not even able to go to work, go outside their house for 2 years, and it didn't even buckle. So we've already seen the recovery within 12 months of people being allowed out of their house. And in fact, property prices increased during that time. It was crazy, and a little bit of a retreat and then a little bit back again. So, probably barring everything bar World War III, the Australian property market's resilient for the fact that you mentioned, supply and demand. And if you look at immigration, and Australia being a highly desirable location within a 10-hour flight zone radius of the two most populated countries in the world, being India and China, we're always going to be a desirable place. And we have plenty of space. And we're seen as clean and fresh and a place to invest, easy to deal with. So we'll always have demand. Demand will always probably outstrip supply, probably in our lifetime.
I think probably relating it back to the question, I don't, as you've just both mentioned, we don't need to see interest rates decreasing to stimulate a buyer inquiry. People are desperate to be entering into the property market, and they have been, as you mentioned, Julian, since last August, September, October. We don't need to see interest rate decreases to create this confidence because, boots on the ground, what we've been seeing broadly is confidence returned when interest rates were on pause for the second time. And so I feel we'll be entering, extremely bullish territory the moment there is an interest rate decrease, but we're already seeing bullish territory across large, Australia's largest capitals, Sydney, Brisbane and Perth. Extremely heated markets in many cases right now, and they have been for the second half of last year. You've got some really interesting...
kind of ties into Damian's thing. If you've built up a war chest, people aren't going to wait 5 to 10 years to go buy their home. They're trying to time their way into a market. Everybody thinks they can time their way in. Nearly everybody can't, but they eventually have to pull the trigger, and once the kind of the first ones get into it, then the herd mentality kicks in, and that's what I think we will see towards the back end of the year.
Definitely. And I think you've got some really interesting data, Mike, and it's quite unique data actually. As a quantity surveyor, you're seeing a lot of the back end of a transaction. So a property settled, you're seeing trends around what types of properties people are buying. Are they buying it remotely, and who is buying these properties? Anything you've seen, particularly in the last few months since September, October, around changes in those trends?
Yeah, look, I think 2023 and I expect 2024 is all about the affordable markets with the affordable price points, right? So the average that property investors spent on their investment property in 2023 was 650 grand. Now, if you remove outliers in the statistical way that ChatGPT likes to do it, which I ran the other day, it's actually only about 550 on average, because every now and then someone will purchase an apartment for 8 million and it destroys our data, right? But let's just say, 550, 650, around that sort of point, we saw a huge gold rush in WA, and I think the big part about that is that it was the cheapest median house price of any capital in Australia outside of Darwin as the territory, right? Hobart actually overtook it. So I think that that's going to be a huge driver. And if you look at things like the Westpac consumer sentiment, there's a really strange disparity between the time to buy a dwelling index, which is high, which is low, sorry, and house price expectations, which is high. So there's an idea that house prices are going to continue to perform, but now's not necessarily a good time to buy. And I think that just comes down to the availability of credit. And Damian made an erudite point about, if you're getting assessed at 9.5%, it's kind of farcical, right? Like there's no projection that sees interest rates getting anywhere near that. So I still think until we see an interest rate cut, and I agree there will be a fire under the backside of the property market, until we see that cut, we're not going to see a huge increase. But I think people pay a premium for certainty. That's why people will pay more for those fixed rates, right? And I think that rates sitting still gives a level of certainty. And if we can just get one rate cut, we've at least got sort of an announcement effect from the RBA that rates aren't going to go up.
Remember,
I
guys,
think we don't necessarily need a rate cut to happen for that interest to accelerate. Just the near consideration that it's going to be much sooner. So if all of a sudden headline started to say, expect the rate cut before June, I think people will start to feel a lot more confident than rate cuts maybe around about the end of this year. And there'll be some data, I think, that will keep coming out that will start getting commentators and economists considering an earlier and earlier rate cut. And banks will revise their forecasts and when they consider a rate cut. Macquarie is an indicator of that. They're starting to lower their fixed rates. And I'm sure other banks and their economist teams will start to consider the relevant new data coming out and revise forward some of these rate cuts.
And is it fair to assume, Damian, too, like the RBA are probably eyes looking over at the US and the European market seeing who blinks first? Because it doesn't even need to happen here.
No. And one thing that they will be critical on, this is the sort of unknown quantity. I think this is what's confusing economists. There's a lot of data that says directionally inflation is rapidly dropping, okay? And you've got very low, terms of trade. We're technically in, let's say, per capita recession. There's every reason to cut rates. But if we do that, and the Fed Reserve is still sitting at 5.4, where they are right now, our dollar will get smashed, and we'll start importing inflation because we're a net importer. So if the Fed Reserve is high and Australian dollar is dropping, our dollar collapses, our inflation rate will stay higher longer because of what we're importing and the terms of trade of our dollar. So, they're acutely conscious of what is happening from that perspective to minimise and have a lag effect on inflation for longer.
Because we are, I think you did touch on it, we are well ahead of the inflation estimates. Each announcement is good news. And so we are, having a compounding effect of good news upon good news. And I feel, we're seeing it in interesting markets. And you've touched on, 550 to 650,000 as a 2023 sweet spot for investor transactions, Mike. We've seen some of the strongest, if not the strongest, predictive data in Australia at the moment coming into working class Sydney. You've got your Blacktown LGA with half a dozen markets, which, gun to my head, you can almost, would be a strongest investment, I guess, markets in the country. And seeing the data and digesting it, it hasn't been 5 or 6 years from a pure data perspective, we've been that bullish on that working class Sydney. So we might see maybe that price point was a function of where was firing on all cylinders. But as the Sydney market starts firing and potentially might be the leader of the pack in 2024, it might be that $850 to $1 million is that sweet spot for investment purchases for 2024. So it'd be interesting to see Sydney really driving that market forward as our largest capital. I might leave that there, guys, if that's okay. So go for it, Mike. No, you go. If you've got a summary, that's great.
Circling back to the question, my view is that we could have interest rates on hold until 2025. I still think we're going to see positive growth in the property market, and certainly growth in the rental market. As Julian mentioned, the construction industry is really not prepared to pick up that supply gap. You know, the government can have a really nice press release and presentation saying we're going to build 1.2 million homes in 5 years. I mean, the government's not going to do anything. That's up to private developers to do the work. And not only are they saying we're going to do it, we've only ever done it once before, 250,000 homes in a year. We're actually now going to do it again, but 5 years in a row. And think about the timing. It is a relatively high interest rate environment, at least to the point where high-rise development pipelines are really, really reduced because the margins aren't stacking for developers. On top of that, we've had a huge amount of liquidations in the construction sector because they were, you know, in fixed price contracts at a time where construction costs grew 18%, you know, in 14, 15 months. And
Absolutely.
so we've got huge undersupply in construction, and that's not an easy fix. We've also got a big pipeline of government infrastructure projects which are pulling that labour away from, you know, building homes and apartments. And we've also got quite a lot of natural disasters that there's still, you know, the threat of more and the lag effect of the remediation works. And I can assure you that there is a lot of money for construction workers in that insurance work, to the point where I've spoken to some of the biggest builders in the country saying, we can't get roofers or we can't get tilers. I'm like, what do you mean? Like, surely someone would really think it's attractive to work with you because you've got a massive pipeline of work. We're like, no, not when they can get, you know, double the hourly rate fixing roofs in cyclone-prone northeast Queensland, you know? So
yes,
supply is a huge problem, and everything's pointing to, you know, growth in the market for me and a continued increase in rents. Just because all the fundamentals are saying there's a huge undersupply, and investors have been exiting the market because of a lot of these things, like what you were probably hinting at, Julian, with the Victorian changes. But again, that's another show.
Oh, it's wonderful observations, and I think it's probably very relevant to the question from Philip, which we may have already touched on. We may have actually already answered this, I guess, in a roundabout way. How is this going to? So how? Let's drag this back to the RBA, guys, because we are speaking quite broadly here. But we have a wonderful new RBA governor in place, and you know, reading through some of her commentary, especially yesterday, but in the last few weeks, publicly, she's taking a very different tone. You know, it's almost like they've had a PR company come into the RBA and they've really listened to how they are perceived by Australians, and they are breaking things down at a level that they really haven't before. And the language I feel they're using is far more accessible. And the theme here, the focus really is on inflation and getting that into check. It starts and it ends with inflation. We know outside of their announcements, there have been separate announcements that inflation is ahead of the estimates, you know, better than their estimates. So, you know, with this as a summary and an introduction, bringing things back to RBA, how is RBA holding interest rates going to impact the property market and property prices? And I believe confidence is building, borrowing power will be the main influence in rising house prices. So that's from Philip. I was going to throw to you for that question there, Mike, and I do feel we have already touched on it probably. So feel free to answer that how you answer Philip how you see fit.
Yeah, look, I think the availability of credit is always the big one, right? I think a lot of people predicted 2023 to be a good year for the property market because they expected interest rates to drop, right? We really sort of got the opposite, and the property market still went ahead. So, you know, with interest rates rising, there's kind of an expectation that the housing market is going to suffer, but it didn't. And I think interest rates can be over-egged in its influence on property markets. But the availability of credit is something you can, pardon the pun, take more to the bank a little bit. What's really curious for me is some of the comments, and there's a whole cottage industry of people that read these minutes looking for these little hidden messages, and I got sucked down that rabbit hole as well. I looked at Philip Lowe's last 3 minutes and I figured out the average was 652 words in their statement on monetary policy, and you know, Michelle, who it sounds, let's be honest, like you have a big crush on Michelle. We'll get to that later. It's 719. So we're talking 10% more words. So perhaps there is a desire to try and disseminate things in a way that people understand. I mean, if she wanted to be a darling and have everyone adore her, she wouldn't have increased interest rates on her first go. So obviously she's still serious about her job. But something that I'm keen to hear from all of you guys, especially Damian, is that they're still saying that our expectations is for inflation to be within the target band in 2025. Now, there's still a lot of months left of 2024. It feels like it's just begun. And they're saying not hitting the midpoint of that range until 2026. Now, of course, they want to achieve a soft landing, but their charter has a couple of key points in it. And one is inflation within the target band. And Michelle herself has said that it's really inflation that's hurting people in this cost of living crisis rather than interest rates per se. So it begs the question, how patient are they going to be to get into that band?
Well, there's a reason why they're still frustrated about inflation.
It's sticky, right?
And it's because let me just say, it's the government. The government is doing things that are counterproductive to bringing inflation down. Okay. Just to give you one example, the rate cut amount changes to stage 3 rate cuts right now. So that it's optimistic, and most economists are reporting this, it's optimistic to conclude that it will not add to inflation. You've just had a recent minimum wage rise. I'm all for, improving cost of living for those that it matters most. Okay. But in essence, you still index the crap out of all your, necessities. Fuel, which will then have a knock-on effect to all other supply chains and therefore products. So, they indexed it again. Indexed alcohol, and cigarettes. So if you drive a car, have a beer and have a cigarette, mate, you are royally in trouble. There are things that are actually happening here, which is look over here, don't look over there. I don't want to seem pragmatic, but that is impacting the forecasts. Because when you think about the amount of government investment, you called it out before, the amount of major construction work that's going on, that has an inflationary impact. Okay, now it's needed, but it has an inflationary impact. Okay, we've got an Olympic Games in Queensland in less than 10 years or 10 years, and that will have an inflationary impact. So all of these other elements, which are generally in the sphere of government, are contributing to the forecast for inflation. And at the same time, the RBA is trying to reduce inflation. So it's a bit of a conundrum on what we do here. I don't think it's the everyday punter that's out there creating inflation. I think largely a lot of these factors are a little bit more sort of broader and macro.
Yeah, and if you think about there's certain subsidies that'll be unrolling soon as well. Like there's an electricity price subsidies, and you talked about inflation. And I think one shouldn't forget that we've got quite a few state elections in 2024, and really the campaign trail for the 2025 federal election, unfortunately, has probably already started, right? And it is a cost of living election for mine. Who knows what will change? Perhaps China will invade Taiwan and everything would be completely different. But to me, I think cost of living is key. And the only real way to make things better for people is to provide those subsidies or the tax cuts. And these are all inflationary. So it's sort of like you've got the RBA on one side fighting with the fiscal policy of the government, and those infrastructure projects are massive. But it just sort of begs the question, like, have they got the timing right of that? Should it be kicked down the road? So yeah, it's a very difficult conundrum that they're in, and like we were talking about off air, there's still plenty of people that are spending a lot of money. Like the amount of people that you see on social media going, oh gosh, these interest rates are so high, and they've just come back from Bali and bought a Range Rover. You're like, you're part of the problem, man.
That's a good point, Mike, because my biggest bugbear with trying to control inflation, interest rates is probably one of the most least effective ways to go about it. Because there's only maybe about a third of the population that actually have a mortgage on a property. And then all you're really doing is we've got a construction problem. Well, great, we're adding to that because it's not feasible for them to go out and build these homes at volume because they can't put up with the cost to service the loans. If we were actually really wanted to be progressive and control in inflation in a really proactive way, we would be looking at making the GST, which obviously wouldn't be very popular for political reasons, but we'd look to make the GST a moving dial because you actually impact everybody then, rather than just impacting homeowners and people who are looking to construct and create jobs. But that's never going to happen, unfortunately.
Well, nobody's got the political, let's say, gentleman's plumbing to get that done, right? And it's the same thing, I think, in the property investor space. And I guess those are the majority of people that are tuning in today, right? They're interested in house prices and property investing and that sort of stuff. And we are in a rental affordability crisis because investors have been disincentivized for a period of, it's going back now 7 or 8 years with, the caps on interest only loans, the disparities between the rates that principal place of residence buyers versus investors pay, even though the RBA themselves say that there's actually a higher risk for owner occupiers in defaults than there are investors. Wow. There's a lot of mess in that. And Damian made a point about, increases in minimum wage, and all those sorts of things are really important. But I wonder, with the top man in town wearing a blue tie at the moment instead of a red tie, is industrial relations something that's part of the mix as well? Because we are sitting in a quarter of a decade highs of wages growth. Now, admittedly from a pretty terrible base, but there's been a lot of renegotiation on those contracts. And again, inflationary pressure.
I think just relating it back to the audience, I think both of you touched on this, Julian and Mike. Our audience are property investors. Generally, we are, really pushing forth to pull ourselves up by the bootstraps and improve, our, I guess, financial position for ourselves and our families. We are focused on interest rates, right? It's not inflation, it's not consumption, it's not the cost of living, etc. We might have, saved up a deposit.
I'd add to that too, Jacob. I'd add to that the interest from the audience is more than likely where do we find these properties that have a higher probability of increasing. And I think that is also really relevant to the points you were both making, Julian and Mike, is that although there are pockets of people really suffering, the mortgage-bound area under stress, we're probably not looking to invest in those areas because the oversupply of listed properties will keep values low. But where are the pockets of people who are not impacted as much by interest rate rises? And that'll constrict supply because I'm not forced or needing to sell, but there may be higher amounts of demand. If we look at Perth, for example, as a way to sort of put that in perspective, mining, we've called out mining, construction, and these skilled, I guess, blue-collar roles where you can get really good money because there's a massive shortage. And now these are going into areas I need to live near where I'm working. And so if you follow trends, I follow where the money's going because that's generally going to lift the price value a lot more than somewhere in the outer western suburbs of Sydney, potentially, that maybe is impacted by a lot more mortgage stress because the socio-economic, I guess, geography of that area is a lot more impacted by mortgage increases. So I think, when you think about interest rates, also about what does that mean for buying opportunities? Because you'll always be able to work out what your budget is, no matter what the interest rates are doing. And the banks are actually going to budget you at 9% anyway. So, it's not really the position that you're considering. It's however the bank looks at it, okay? But what can I buy and where is the best place to buy? That's always going to be the next most important question.
Yeah, and that's all coming back to housing shortages once again. So we're focused as investors on interest rates, and the conversation is all about interest rates. And, this conversation has been all about interest rates. But the other side of the equation is rents in certain locations across the country where you've got dramatic housing shortages and very high demand from new Australians and old Australians, emergent industries, industries that are really firing on all cylinders. You've got pockets of Australia, large capital pockets, where rents are still outpacing whatever's happening in interest rates. Even since interest rates stopped increasing the last 3 to 6 months, you've had tremendous rental increases due to the housing shortages as well. So as investors, all the eyes are all focusing on interest rates, but we need to keep an eye on what's happening with rental increases as well, because that's the other story. And for us, they are the two numbers that are very relevant as investors, and it's good news as far as both of them are concerned. Expect rents to continue pushing forward for the next 3 years. There are no short-term solutions for the lack of housing, the lack of investment properties, and potentially interest rates stabilising and decreasing. So things are starting to work really strongly in our favour. I'm just aware of. Go for it, Mike.
I think the shortest term way to influence the rental supply is to stop demonising investors, right? Who have been selling en masse. We've seen quite a lot of stories from I think it was PropTrack, where they're tracking the properties that they can see had been rental listed and then they were being sold. And we've also tracked data in and around the Queensland land tax change, which was repealed, but there was about 98 days where people could have made a decision knowing that they would be impacted by those changes. And we saw a marked double-digit percentage decrease in investors purchasing in Queensland as distinct from other states. So there's those political blunders that are exacerbating it as well. And just quickly, my 2 cents on rents is that I think rents can't continue to grow as quick as they can. And what I mean by that is that the median rental price in Australia can't be $2,500 this year, right? Like, it has to stop somewhere, because I think people will just moderate their behaviour or their living arrangements. More people will tend to bunch up. They'll rent out that spare room. They'll stay more with their parents. They'll gravitate towards dormitory style things. I think we saw a decrease in the household formation rate. We saw, just the divorces during the COVID period equate to a need for an extra 120,000 homes, right? That's just crazy numbers. So I think, I don't think rents can continue to rise at the pace that they have, but there's no fundamentals pointing to me that says that anything has changed. So it's really just a moderation of behaviour. There's nothing to me that's saying rents will come down or they'll soften because there's a higher supply or anything like that. I'd be interested to hear the panel's thoughts on that.
I think you're right, Mike. There is no short-term, even medium-term solutions to our, rent pressure issues. I won't call it a crisis because it's been manufactured. Supply is what will lower rent. When there are more available properties for rent, the price will come down. Because landlords will have to adjust what they see as reasonable to get someone in, or else they're wearing the cost of that investment. So, it's a market economy. Right now, with immigration numbers the way they are, other factors, like you called out, Mike, around divorce rates and just the additional need for bedrooms, we look at it on terms of number of bedrooms required. And that really is painting a picture based on what we see in building approval data. There isn't enough, and it's not in the pipeline, and it won't be able to be completed even if it was in the pipeline because of labour constrictions. So, there is really, I think, a longer term view here on the stability of these sort of rent values, which will then spill over in areas to, is it cheaper to buy than it is to rent, particularly if interest rates are starting to drop.
Yeah,
that's one of your favourites, Jacob, the old rent to buy.
And then you have this forced sort of competition for property, and that will put prices up.
Yeah,
I think it's important. Just quickly, Jacob. Sorry to hijack this topic, but I think it's important to give a little bit of context to the talk about this rental affordability problem. If you go back into the last, say, 26-year period, rents actually didn't outpace inflation. Now, most people whose rent has gone up $100 a week in the last year or so will find that difficult to believe, but that is the fact. Rents have really been in the doldrums forever. So is it the fact that rents have risen too fast? I don't think so. Or too far. It's the pace of change that's really hurt people, right? Rents have risen quickly. That's where people have struggled. But rents have not risen in any dissimilar way to interest rates, right? And I think the data is showing us that landlords typically have been passing on less of the costs than what they've incurred themselves. Now, no one wants to jump in the media and have like a bleeding heart story about property investors. That's just not popular for politicians to say or for media to say. But, it's just that extreme pace, and it's been suffered by the investors and the renters combined.
I'd agree with you, Mike, because I think as an investor, you're going to try and cover your cost base as best you can, but you're also, if you're getting a rate cut and you've got a lovely old lady as your tenant, you kind of, your instinct is like, well, I'd rather keep her there and keep that rate as what it is, rather than, though, yes, I've got 20 people that'll be in here tomorrow for an extra $50. I'd rather keep a really good tenant in place. But at the same time, if your interest rates have tripled over a 2-year period, you're going to start to pass those costs on. So I think,
Yes.
I mean, albeit, even if we hold or if we see a cut, I think we'll start to see a little bit of stability. You'll still see some markets. Obviously, Melbourne has now started to go through that rental increase because we went through that really high vacancy rate post-COVID when everybody left. But I think you'll definitely start to see it taper off as we start to get rate cuts come through.
Guys, it's a really interesting discussion, and remember that, I keep coming back to this. There are many markets, and they're pushing and pulling at any one time across Australia. And even if we just spoke at a capital city level, we've got our major capitals doing very different things right as of today. And this is probably coming to our final question today from Jonathan, who we helped purchase a property over in Perth in 2023. Big shout out to Jonathan, who's actually also based down here in Hobart. And he's asked very simply, when can we buy in Hobart, Tas again? Without going into your personal circumstances, Jonathan, I know your first property was an investment purchase, so you're a rentvestor over in Perth, and that was a decision that we came to because we did feel that was going to give us an opportunity for the most capital growth and investment return, in the first year after purchase. I'm sure you agree. I think the team have had a look at it, and between 15 and 25%, depending on the comparables used in capital growth in under that year period. So it's a very consistent story in Perth, and it's a wonderful place to generate those returns from 2023. But in your personal circumstances, I feel you haven't added this to the question, but potentially looking at a principal place of residence down here in Hobart. Hobart's actually exhibited, and just as a side note, we're going to hold over a lot of these research questions until next week. We have released our February data dump, so definitely tune in next week for our mastermind session, which will be a research-centric session. Come along and bring your budgets, bring your target areas, bring your thoughts around research about data, and we'll answer all of those in that deep dive session. And all the data will be available for you at no cost as well, so you can go away and have a play with that. Tasmania, like Sydney, has actually been exhibiting very strong predictive capital growth signals now for around 6 months. We have had a correction in parts of Hobart, things pulling back over the last 12 months broadly, but it has been exhibiting very strong predictive signals for some of the key markets throughout Hobart for some time. The problem is with Hobart, our yields just don't compete well against the yields you can achieve in Brisbane and Perth. So for us, the important thing is not the yield, but the trend line of the yield figure. So rents and yields have been really strongly growing in Hobart to a high point in the rental cycle for the Hobart market for some time. And we are in a very good position for predictive growth in Hobart. But the yield just doesn't sit at the same levels that you can achieve in Perth and Brisbane as an example. So that's why we haven't been acquiring properties here as such for clients. If you are buying for a principal place of residence, Jonathan, which I'm thinking you might be looking to do, refinancing that growth and equity you've achieved over in your Perth property, then you're not going to be looking for that rental return. You can't really, we've got great indications of capital growth in Hobart market, and if you're living in that property, that's really the only return you'll be generating. So it might still be a good time now to consider Hobart for a principal place of residence purchase. But just on that, we will be taking a deep dive into location. So this is a mastermind format going forth where we do have a theme around the conversation. Next week, obviously this week is RBA and more macro policy. Next week, we'll be taking a deeper dive into research, where to buy, and what is the data that's justifying those decisions. So Please gather those questions forth. If I have missed any questions throughout this conversation, I'll jump over and make sure that we get those answered in the Facebook group. Thank you so much for attending, guys. It's been a wonderful conversation. Any final comments?
Thanks for having us on board, Jacob. Always great to have a chat with Mike and Julian and yourself. So, love being here. Thank you.
Thank you. And just while you're on that, Damian, what's probably the best way to get in contact with you if someone on the line wanted to?
Head over to our website, the Australian Lending Investment Centre, alic.com.au.
Wonderful.
You'll see all of our investment lending managers listed there, and they each have a contact direct page, or myself as well.
Wonderful.
And that comes through, and we get immediately in contact with anyone that is looking for a little bit of time to hear what we have to say.
That's awesome.
Talk a lot, as you know.
No, it's good. And what about yourself, Mike? How can we best get in contact with you?
Likewise, it's a pleasure coming on, and certainly learnt a lot from Damian and Julian on this one. You
Not
can
much
go
for me,
to,
though. I'm sorry about that.
No, like I might have said yes, but the polo. I'm going to take points off for the polo. MCG Quantity Surveyors is the name of my business, so you can go to mcgqs.com.au or just search Mike Mortlock. You might pick up the odd Today Tonight episode or some dodgy thing I did in my youth, but most of it will be legitimate property economics and tax depreciation advice.
And how about yourself, Julian?
Hopefully not.
Just Julian at ripehouseadvisory.com.au is the best way, or just jump on the website and the team can reach out as well.
Amazing. Hey guys, it's been an absolute pleasure. Thank you very much for taking the time out on a Wednesday. And I look forward to getting some comments from the audience. What can we improve? But also any other relevant points or questions around the topic of conversation. I'll make sure to go out and gather those responses for you and bring them into the one place. So maybe head over to the Facebook group for that conversation, High Performance Property Investment, or comment on our YouTube channel, and we'll make sure those questions are answered for you. Thank you very much.